Hi, everyone. Hi, Paul.
Hello, Ingo. Good to see you.
Good to see you. How's it going?
It's going very well. Almost the weekend. Very good weather here in Cologne, so I'm in a good mood.
It sounds very promising. I think we'll wait maybe another minute to give people a chance to join, and then we'll get started.
Sounds great.
Hope we
you
have.
Can maybe already share the presentation so I can make sure everything works.
That's a good idea.
Yes, and then if you just click on the first presentation mode. Yeah, that's perfect.
Perfect.
Great.
So I think we have a lot of people joining today.
I think it was a record number of registrants that we had, both on LinkedIn and our Zoom invite from the guys who are already in our emailing list, which I think indicates that this is a really important topic today. Inflation. We had a webinar about this, I think, a little over a year ago, roundabout, and it was already a hot topic. But now I think, due to a variety of different changes and additional challenges, it's only become a hotter topic this year. So I was watching some of those earnings calls this quarter from large corporations, and inflation is really the topic that's on everyone's mind, especially in industries that are quite affected, such as the food and beverage industry, for instance, where we have a few clients at Buynomics as well. But yeah, maybe we can already start with the Buynomics intro, Ingo, as people are still joining us here. Today, our founder, Dr. Ingo Reinhardt, will be kind of leading us through this webinar. He has over 12 years experience in pricing and revenue management, also developed the Buynomics method. And I'll be moderating a little bit on Paul. I'm head of sales at Buynomics. So some of you already know me from the demos that we have, or the ongoing conversations that we have with you as clients. And I'll be moderating a little bit, and I'm always happy to answer any questions you have, either in the chat or also as follow-up by email. On the next slide, a quick intro to Buynomics for those who don't know us. We have a demo prepared today, and it shows kind of the power of the Buynomics software, which really empowers better pricing and revenue management decisions. It's a much more holistic approach. We have a very unique method behind it, which really reflects the complexity of how consumers make purchasing decisions, which is not only affected by price, as we all know, and we'll see that also in the demo and in some of what Ingo will be saying, but it's all affected by price. So that's, I think, in inflationary context, quite interesting. And our software is super accurate, over 95% in terms of forecasting, which then allows you to make these decisions with a high level of confidence, and therefore also much faster because it's in a software, and finally also much more profitable, up to 7% higher profits in consumer goods industries, up to 20 for high gross margin industries like telecoms and software. So quite a powerful tool if you have it, and especially in inflationary times. So maybe then one last slide on Buynomics, Ingo, before I'll hand it over to you. Buynomics is really a global company. We're based in Germany, but with large companies, we're already in markets across the globe, be it in the Americas, Europe, Australasia, you name it, and we're still growing quite strongly. So we're happy to see more and more partners onboarded to the Buynomics platform. I see someone already using the chat. Someone's asking whether you will have access to this presentation. Yes, we will send a follow-up email where you can watch the recording and also download the slides as a presentation. So yeah, look into your inbox after, and it should be there Monday or Tuesday next week. And yeah, feel free to use the chat to ask questions that I'll pose to Ingo at the end of our conversation. So type away if you have any questions, and otherwise I'll hand it over to you, Ingo, for this very interesting topic today.
Yeah, thanks, Paul, for the intro and good introduction. So let's get started. I think what we want to discuss today are essentially three topics. First is just give a brief intro on how inflation matters for pricing. Won't spend too much time here. I think the connection is fairly obvious. Then we'll talk a bit about traditional methods on using price elasticities and so on, and the more advanced solution that we will also just quickly highlight here. And then, of course, inflation poses a number of challenges, but I think with challenges also come opportunities, and we want to discuss these. And for us, the focus, I think it's not generally on inflation. There are many TV shows, earnings calls, as Paul mentions, and so on, that talk about inflation in general. We really want to focus here today on what that means for pricing and what are the options to address inflation, and also what are good ways of dealing with it. So let's get started. I think not much needs to be said to make clear that inflation is a big topic. I think for us, and that's a post we had last year already, the strongest indication that inflation is real was when we saw that here in Germany, the €1 shop had increased prices to €1.10. I think that's something that took them a while to do, but I think that's a very strong indication that inflation is real. And also, I think also as Paul mentioned, it's on everyone's mind. So in all the earnings calls that I've also heard, inflation is a big topic, and you see that companies that are dealing well with inflation are doing good in the stock markets. Companies that have difficulties pushing forward their cost increases to the customer are having difficulties, and this is really an opportunity or a time where pricing matters a lot. I think today, I heard the number here in Germany, where we are located, inflation has increased to more than 7%. I think in the US and other countries, we're at a very similar level. So it's really a big topic. I think no one can confidently predict if inflation will stay or if it's just transitory and will decline after a while. So in any case, we need to be prepared for what's coming ahead. And I think often there's just this one number presented, inflation rate is X, but in reality, the inflation is sort of an average across different prices or different products. And in some sectors, and we have one here, food and beverage commodity price index, we see that inflation is much, much higher. And that means that we can expect inflation to go up or continue going up in the coming months. As, for example, here, the food and beverage commodity price index has increased almost 80% in the past 2 years. So that's a very significant increase in costs for many companies. And the question is how to best deal with that. So I think that was sufficient as an introduction. And now let's go into the topic of pricing itself. And when we think about inflation in our field, in the pricing world, I think there are three sources of inflation, or three levers that are particularly important. One we already mentioned, increasing costs. So if commodity prices increase, then of course that means that you have to think about also your product prices, and there's typically a very direct connection between COGS increases and product price increases, but also other effects are important. Competitors are always, of course, play a strong role. If competitors increase their prices, it makes it much easier to also increase the own prices. And also when there is inflation, and particularly inflation that differs across sectors, then this has an enormous effect on consumer demand. In Germany, for example, energy prices are massively increasing right now, so people have less money for other topics. If inflation persists for a long while, then wages go up and people have nominally more money, which also impacts how much they can spend on certain categories. So this matters a lot. But I think what's important here is that there are very different time levels or speeds of these effects when it comes to their impact on pricing. So for example, cost increases are typically pushed onto prices very quickly. So if commodities, sugar, dairy products, milk, for example, if these prices increase, then typically product prices increase very quickly because companies can't really afford to not do it. The same way if competitors change prices. So for example, and this goes in both directions, if a competitor decreases a price very drastically, then you need to think how to react to that. Also, if a competitor increases prices quickly, this is often an opportunity to also follow. More midterm are changes in customer behavior. So if, for example, wages increase because there is pressure on employees to increase wages because of higher prices. This, of course, has an effect. Sector shifts with increasing inflation. People maybe go less or have shorter vacation trips, and then they have more money for other sectors. So all kinds of things are going on, and I think there's a broad, not only literature, but there are many providers that provide insights on changes between sectors and how much money consumers can spend on specific sectors. And this is something that's more midterm. So that's something that evolves not immediately, but typically within a few months. And then I think there are these long-term effects of inflation. So when inflation becomes normal, as we're seeing in Southern America, for example, in some countries, when you have 40-50% inflation in a country, then you don't have annual price increases, but you maybe have quarterly price increases. You have people get higher wages, negotiate wages not once a year, but every 3 months, for example. And then inflation becomes institutionalized and much more difficult to get rid of. And once you're in that stage, I think it makes sense to plan with an ongoing inflation. I'm not sure if we're already there, but it's important for pricing to understand that there are very different speeds. And also this means that if you're involved in pricing, you need to react to these different speeds in the appropriate order. So for example, when you think about your pricing model, in the short term, maybe willingness to pay of customers do not change, competitor prices change, cost change, but the willingness to pay of customers doesn't change in the very short term, but it may change in the mid to long term. So these are some things to be aware of and use appropriately in any pricing model or pricing decision. So that means typically with inflation comes more complexity in terms of pricing because prices change, but with this also come a number of opportunities. So the challenge is you need to do price changes much more often than you would in an environment where you have an inflation rate, as we had for a long time here, around 0% or 1 or 2%. You have to be much quicker in your price changes, and it may happen that, or there's certainly the potential for larger errors. If inflation is 8%, or you get the estimate wrong for the next quarter, you think it's 10, but then it's 15. So more errors can be made, but you also have the chance to correct errors more quickly because you, for example, don't have to only annual price changes, but you have the opportunity to change prices on a quarterly level. And also, you have the opportunity that that price increases, of course, in an inflationary environment are typically more accepted than when there's no inflation in the market. And I think there's a small side effect, at least in the short to midterm for many pricing professionals, is that if costs increase and you have the opportunity to pass these on, it becomes easier with inflation to achieve at least nominal goals and objectives. So if you need to increase your revenue by, let's say, 3%, that's of course much easier in an inflationary environment. So for a short time, it becomes easier, I think, for many of us to achieve goals. Of course, then mid to long term, these goals typically become adjusted. And then when inflation goes down, that's when it becomes more difficult to achieve these goals. All right, so what does the traditional pricing tools tell us about inflation? Of course, there are many pricing tools. There are things like cost plus pricing, where inflation is very naturally passed on consumer prices. There is value-based pricing. It's not really clear, or depends very much on the version of it, what it means in terms of inflation. But I think the clearest prediction comes, or the clearest tool is a price elasticity-based pricing. And I think, at least from what we're seeing with many people we work with, is that price elasticities are used by very many in the pricing field still. And the question is, and I'll go over this rather quickly, is if you know the price elasticity of a product. So we have here an example where, if you look on the right side, you have a commodity that has a cost of 100 euros, and you have a price elasticity of -2, then the optimal price of the product is 200 euros, as margin times elasticity should be -1 in the optimum. And now if prices increase from 100 to 110, so cost increase of 10%, the question is, what does it mean? So what's the best reaction to this cost increase? And you would think that if you know the elasticity, then you also know how to pass on this cost increase. But in reality, if you go through the math, it really depends not only on the price elasticity, but it also depends very largely on the type of demand function you have. And if we just look at two typical examples, linear demand, so you have, with every increase in euro increase in price, you lose the same amount of customers. You have linear demand function. If you have, for the same percentage change in price, you lose the same percentage in customers. You have an exponential demand function, so that's when elasticity is constant across the curve. And these are, I would say, the most common examples of demand functions that we see in practice. Then you see, and if you go through the math, that the implications are very different. In the linear case, you pass on half of the absolute cost increase. So the cost increase 10 euros, you pass on 5 euros. And in the exponential case, you keep the margin constant. So if your costs increase by 10%, you also need to increase your price by 10%. That means in the linear case, you go from 200 to 205. And in the exponential case, you would go from 200 to 220. So the difference at the same, and it's both with the same price elasticity, the advice from these different demand functions would range from 205 as a new price to 220 as a new price. So that's a massive difference. So I think and because it's really difficult to assess which one you have in practice. If you look at your price versus volume graphs, you see that it's really not easy to tell which one of them it is. And so the quintessence, I think, with these traditional tools is that just knowing the price elasticity is almost entirely useless even in something so simple as properly passing on a cost increase. So that's, I think, a strong indication that more capable tools are needed, and we just happen to present one on the next slide. And also what I think a problem is with elasticity-based pricing, it becomes very apparent when you think about your actual options, is next to passing on a cost increase in terms of a list price change, you have many other options. So you have the option to change the pack size. You go maybe from a kilo to 800 grams. You can maybe change the assortment. You take out the cheap entry product and add a more premium product at the top. You can change the depth, frequency of promotions. So there are all kinds of things that you can do. And I think particular with the options that we have right now and the increased complexity that comes from inflation, it makes sense to think about proper solutions that can address these complexities. And let me just show you what I mean with this. So Paul, can you see my browser?
Yes, very well.
Okay,
thanks.
Perfect. So a very simple example that we want to go through. This, I think, as simple as it gets. So we're selling fruit. We sell apple. Our competitors sell oranges. Apples can have two sizes. They can be 200 grams, 150 grams, and we can run a promotion here, just a simple flyer promotion, or we can go without a promotion. And what we do is, so we offer the 200, so the larger apple, the 200 gram apple, at a regular price of €1, and we sell it as a flyer promotion reduced by 20 cents, and therefore we sell it here at 80 cents. Our cost are 30 cents here in both cases, and our competitor sells oranges. The willingness to pay of customers is pretty much the same in both cases. So they have an average willingness to pay I think a little bit above €1 for both the apple and the orange. Orange also has costs of 30 cents, weighs 200 grams. So we have here our value drivers, and we'll later look at what if it's a valid option to go down from 200 to 150 grams. So, and what this here does is essentially, and I won't go into too much detail, in the background we have what our solution that we develop for pricing, what we call the virtual shopper. And the idea is that we have a large number of virtual shoppers with preferences like real people, in this case here for apples and oranges. And these virtual shoppers can buy the apple, they can buy the reduced apple, and they can buy the orange. And just one thing to clarify. So what we do is in half the time, 50% of the time, so let's say, for example, 26 weeks, we offer the apple at the regular price, and the other half of the week, 50% of the time, we offer the apple at a 20-cent discount and promote it with a flyer. So that's the situation that we're in. And this is the outcome. So we see that we sell 211 apples at the regular price. During promotions, of course, demand is much higher, the price is lower, and we run the flyer, so there's more going on. We sell 335, and our competitor sells oranges all the time at the same price, and he sells 342, but across the whole year. We can very easily see what happens if, for example, we change the price of the apple. See what happens if we change the price of the promoted apple. You can see what implications that has for revenue, profit, and so on. And also see the elasticities here. We already see that in this example, elasticity is not constant. It changes, it increases with higher prices, as it typically does. So we see that there are all kinds of dynamics going on. And what we also see, for example, if we change the price of an apple, we go up 10 cents, we lose 40 units, and 30 of these go to the orange because there are to some alternatives to some people. And there's also a total loss of 10 units for the whole market. So what we're seeing is we have the full dynamics between these markets, between these products. And now what happens is that because of inflation, the costs of everyone go up. Quickly save. And what happens then with these increased costs is that the units are still the same, the revenue is still the same, but the profit has decreased for us. It went from 316 to 61. And now the question is, what can I do? So, and one option, of course, is, let's say we pass on the 10 cent, competitor does the same, and we go here to 302 euros in total profit. So it's a bit less than previously, but we would say we regained some of the loss that we would have had if we had kept prices the same. We can, if we want, look if there's a more profitable price, maybe there is one here, but there's not in the promoted case. All the other, the lower price points are less profitable. So it's a very easy way to see what a price increase would do in the case of inflation, of cost inflation. And like that, looking at the time, let's just look at the summary here. What we can do is, and I've, as in a cooking show, already prepared some examples. So what we have is here the base case before inflation, and those were our unit sales. Then we have the base case after the cost inflation, same sales, but let's go look at the profits, reduced profits because our costs have increased. Then we have the case that we just looked at. We have the cost increase and increased our prices by 10 cent in both cases. And then we can also look at other cases. So here's a case where we kept the price the same. So we're still selling at €1 for the unpromoted apple, 80 cent for the promoted apple. But we only have now a smaller apple, 150 grams. That's a bit cheaper than the previous one. And as another option, we might think, okay, let's increase prices and reduce the share of promoted weeks. In this case here, we went from 50-50 to 70-40. So 70% of the weeks we had an unpromoted price, 30% of the weeks we had a promoted price. And we see, if we look at these cases, that in this case, in this particular example, of course, that's always different in each case, and depends very much on the dynamics of the markets. It would be the best solution to reduce the size of the apple. And of course, in this made-up example, that's easily possible. But if you think of most packaged goods, it's easy to reduce the size of a package. And we see, if we compare the profits in these cases, that in this case, we go from 315 to 319. So it's even a bit better, a bit more profitable than the original case. So in this case, we actually were able to improve nominally our financials in the case of inflation. If we compare the whole market, so including our competitor, the orange seller, 541, 554. So overall, the total profit in the market has decreased. So because our competitor increased price from €1 to €1.10, and we decreased the size of our products, we captured a bit of the competitor's product profitability. So this is just a very simple example, and just because we were looking at just this very simple case here. The same can, of course, also be done not just with very simple cases, but we can do the same with more complete markets. And what we're doing with our customers is we use the solution to simulate and model the complete dynamics in markets where we have dozens or even more of different products, and are able to simulate the effects in the market. All right, let's go back to the solution. I think we can go straight to the just give me 1 second.
Thanks a lot, Ingo. I already have a question here in the Q&A. So if we want to jump to that, and again, there's a few more slides here about conventional methods versus and what their challenges are. I'm sure all of you are familiar, and kind of reiterating what the benefit is of looking not only at price in isolation, but at product, promo, assortments. I think that was quite nicely put with this very simplified apples and oranges example, that you need to pull different levers, and you need a tool that can reflect those different levers, not only a one-dimensional kind of view like an elasticity-based model would do. Someone is asking in the Q&A, were the cost proportionately reduced 200 grams to 150 grams for the case 4 in this example?
Yeah, so roughly. This is typically not in reality. It's not linear. In this case specifically, we went from 200 to 150 gram, and the costs went from 40 cents to 30 cents, and that's proportional here. But it doesn't have to be that way in reality, right? So, and I think that's important. So you can't draw direct conclusions from this example in the sense that you say, okay, it's always best to decrease the size of the product. That's always very, very case specific, depends on the costs, depends on the competitive environment, depends on how customers value different products, different product sizes, and so on. So this can't be decided in general, but only in specific cases.
Yeah. I think especially given competitors are moving their prices and pack size at the same time, there's no one-size-fits-all answer in that sense. We had another question about these virtual shoppers or consumers that you mentioned. And the question was how we actually produce that model, or how we parameterize that model, I guess is what they meant.
Yeah. So what we have is a base model of how customers make or shoppers make decisions that includes something very typical, like a utility model. We know from other fields like conjoint studies, for example. And then on top of that, we also have the option to include a behavioral model so that people or these virtual shoppers can make a difference between €1 and 99 cents. They prefer, if you have a good, better, best offer, the middle option, for example. So they're fairly flexible in the way they're set up, and they are created from empirical data, and we can digest pretty much all the typical pricing data. And the one that we use most often are in consumer goods, sellout data, which allow us to look at the past dynamics in markets and use them to infer how customers or how shoppers value different products and what their preferences are.
Great. Thanks a lot, Ingo. I think we answered all of the questions. So maybe we can go to the next slide about, oh, I see another Q&A coming. Yes, so someone's asking again whether this lecture will be available on the internet to watch again. As I said, you will receive that in your inbox on Monday or Tuesday once we've uploaded everything. And check your inbox to see both the live recording, but also the presentation that we will be happy to share there. Our next event is at the European Pricing Platform FMCG event in Amsterdam. So if you're in the FMCG industry and you are there, let's meet up and let's have a conversation. Would be happy to see you there. We're giving a little workshop of how to forecast shopper and consumer behavior using AI, which will dive a little deeper into how we're doing what we're doing outside of the inflationary context. So I think that's also quite an interesting one. And we'll announce new online webinars in the next few weeks. So stay tuned and follow us on LinkedIn and our newsletter in order to be in the loop with all the latest content from Buynomics. Yeah, thanks, Ingo. I think great session today. If there are no further questions, I'll wish everyone a happy weekend, and we'll see you next time.
Yeah, same from my side. Thanks for your time. Have a good weekend, and see you soon.
Bye.
Thanks. Bye.